big news from the Fed yesterday. Let's go ahead and put this tear sheet up on the screen. So they met and they have, which this was expected, decided to further lift interest rates by another 0.5 point. They also announced that they're going to begin that balance sheet reduction that is set to start on June 1st. The way that they do this is they don't actually sell off the assets. These, of course, were, the reason that their balance sheet is so large is because of the extraordinary efforts that they undertook during the pandemic to essentially backstop the stock market and the bond market. Measures that went beyond anything they've ever done before, including during the Great Recession. So now they have this massive balance sheet and they've got to try to unwind it. They don't do that by actually selling things off. At least they're not doing that yet. Instead, they just allow things to mature and sort of like naturally fall off of the balance sheet. They're going to move forward with that, set in motion a plan to trim their portfolio of treasuries and mortgage-backed securities by as much as $95 billion a month. Question mark as to how much of an impact that will have in terms of reducing demand and sort of tightening the economy. And we'll see how that all plays out. But the big news that he made, that Jerome Powell, Fed chair, made was not even so much that announcement, because that was broadly expected and sort of already priced into the stock market. During his press conference, he actually said, we are not considering going beyond these 0.5 percentage point raises. So the exact quote was, so a 75 basis point increase is not something that committee is actively considering. I think expectations are that we'll start to see inflation, flattening out. And he said, I would say we have a good chance to have a soft or soft-ish landing. On that news, basically saying, everybody relax. We're not going crazy. We think we're getting inflation under control. We think we can handle the soft landing. We're not going beyond the 0.5 percentage point increases. The stock market had a huge rally. Stocks jumped sharply on Wednesday. It was the largest stock market increase of this year. I think the last time we had a bump like this was back in November of last year. So this clearly eased a lot of minds ultimately. The other thing that the Fed is really looking at here is whether or not they can cool off the housing market. Because of course we've been covering how, prices have been insane. The number of offers that buyers are getting has been insane. You better show up with all cash in hand and over the listing price in order to have a prayer of getting into this housing market whatsoever. And so while the Fed rate isn't, directly tied to mortgage rates, we've already seen mortgage interest rates climb significantly at the fastest pace that's ever happened in history. And there seems to be some early indicators that is starting to cool down the housing market. I was reading, I think it was a Wall Street Journal article that put it in this context. It was it's still very hot, but maybe now instead of getting 20 offers, you get 10.
Right.
And so the number of, new mortgages and offers on homes and people who are touring homes as a metric, all down significantly year over year, all down month over month. So that's one of the things that they're really looking at, because a lot of these and this is something else we've talked about on this show, of why the Fed is not exactly ideally positioned to deal with a lot of the economic problems that we ultimately have. They just have this one narrow toolkit, and it's a very blunt toolkit. This is one area where they think they could actually be effective in helping to cool inflation, because some of the other things are really out of their hands. The Fed lifting interest rates does nothing to help the fact that Shanghai is locked down, as one perfect example.
Yeah, and one of the things I've been trying to point to, my friend David Sachs, the venture capitalist, put this up there on the screen. He had a great thread on Twitter yesterday, declaring investor sentiment in Silicon Valley is the most negative since the dot-com crash. And he's got a series of graphs that he points to there about the major corrections in the internet index, in the fintech industry. Here's what he says. So what happened? $10 trillion of money was printed in response to COVID, caused an asset bubble and a spike in inflation. In response, Fed turned hawkish, which is causing rate expectations to rise. This is hammering growth stocks. While there will be a bounce back, there was, over the last last 6 months, the market bounced back to the historical mean on valuations. That anomaly was COVID. So from here, the market will go up or down based upon rate expectations. If inflation proves transitory, there is upside, but the reverse is also true. If inflation is more persistent, there is a downside. And so what he points to is that there is a risk to earnings from a slowdown in the economy, which has not yet broadly materialized outside of COVID stocks. So will B2B or business-to-business stocks be impacted? This will, of course, decrease the overall business environment. And then he points even more so to this. Venture capitalists take their cues in the private markets from public valuations. More directly, the large crossover investors who provided most of the late-stage funding operate in both public and private markets. So when you have less capital from one and not increase that you can borrow against in others, that decreases the amount of money that you can then add into the overall private market. So really what it just points to and what he's saying is that for a variety of factors, inflation, overall slowdown, and now just the relationship between public and private investors and also the amount of kind of quote unquote dumb money that's been operating in Silicon Valley, it's going to change the way that tech stocks are now valued and possibly could for the next decade. I mean, Bill Gurley, who's one of those guys who invested, I think, in Uber and let's just say Uber. I know that one for sure based upon the books that I've read. He put out an entire thread of the same thing saying, listen, we've had a bull market now for a decade.
Yeah.
Most of you people have no idea what it's like to operate in the bear. And he's like, and I think that's where we're going to be at.
I thought this particular part was interesting where Sachs said, will there be a bounce back? There was.
Yeah.
Over the last 6 months, the market bounced back to the historical mean on valuations. The anomaly was COVID, not now, because you did have the Fed injecting trillions of dollars into these markets. And so you had bubbles basically across the board. And so now that things are getting back to what the historical mean is, it feels like a gigantic collapse, but in reality, what was out of the norm, what was going on during COVID. One other sign that some of the sort of irrational exuberance in the markets is being squeezed out right now. Go ahead and put this next piece about NFT sales. NFT sales are flatlining. Is this the beginning of the end of NFTs? This is from the Wall Street Journal. So what they say is the sale of non-fungible tokens or NFTs, aside from our lovely purchase of the CNN Plus NFT.
Right. That's right. I hope that one's gone up.
Made our little contribution to the NFT marketplace.
Right.
Fell to a daily average of about 19,000 this week. That's a 92% decline from a peak of about 225,000 in September. The number of active wallets in the NFT market fell 88% to about 14,000 last week from a high of 119,000 just back in November. They say rising interest rates have crushed risky bets across the financial markets, and NFTs are among the most speculative.
Wow.
So the bleeding edge of sort of the market pullback and some of these reassessments and, reality of the Fed drastically changing their policy here, hitting the NFT, mostly scam market pretty hard.
Not a surprise. I feel bad for anybody who's got a majority of their net worth that were tied up in these things, but
Get out while you can, guys. That's all I gotta say.
I guess what the game looks like over there.
Yeah.
So good luck to anybody who's involved.
Cable news is ripping us apart, dividing the country, making it impossible to function as a society, and making it impossible to know just what is true and what is false. But the good news is they are failing and they know it.
That is why we're building something new, a new mainstream, a healthier one, something more trustworthy, something that we are going to need in one of the most pivotal times in American history. We are building up here for the midterms, for the upcoming presidential election, but we need your help. So if you can help us out by becoming a premium member today at breakingpoints.com, we're trying to change America for the better and the entire world.
So what are you waiting for, guys? Go to breakingpoints.com and sign up and help us build a new mainstream.